Welcome to the Excluto podcast. I'm your guest host today, Vijay Rajendran. I'm a Silicon Valley-based investor and executive coach to startup founders and investors. And I'm pleased to welcome to our podcast today, Manu Rekhi. Manu is a general partner and managing director of Inventus Capital Partners, and I know we're going to have a very exciting conversation. Today's discussion, as usual, is just for informational and educational purposes only and is not investment or financial advice. And so with that, we're looking forward to getting some deep insight and really interesting stories and lay of the land from Manu today. So Manu, on that note, welcome and thank you for joining the podcast.
Well, thank you, Vijay, and I'm really looking forward to it, and thanks for having me.
I think to sort of set the stage, I'm sure our listeners would love to know more about you and where you're from, where you grew up, your journey into venture capital.
Sure. It was by accident. I didn't never expected I would end up on this side of the table. I've been a scientist, an engineer, a product manager, founder. And I think that was a pathway that I sort of carved out for myself. My initial background, I think maybe sort of gives it away. I started out as any Indian kid, you had two options growing up. It was either be an engineer or be a doctor, right? And so I was trying to keep both my parents happy. So when I started at Boston University, I actually enrolled in both biochemistry, molecular bio as my major, and then computer science as a minor. I think I was sort of torturing myself, and it took a while for me to realize, okay, I need to pick one or the other. And so I went down the molecular bio pathway by my last year. I was also working in the Human Genome Project, which allowed a lot of my computer science and the technical stuff to sort of come into play. And fast forward, I think, I realized my personality didn't really work by being in medical school or being a doctor or being a scientist. I think it was sort of a journey that I had to go through myself. And so my fallback was actually the other skill I had, right? And but more importantly, I think computer science, the word science, is actually a misnomer in computers. It's the best ones are hackers. And I think my training as a scientist, being on the molecular bio side, actually allowed me to sort of think very differently. And so I became sort of define myself more as somebody, define problems rather than solve them, right? So I could work with some of the best engineers and people who could solve the problems, but I think somebody has to define what those problems are, right? And I think it has served me well as an investor now, trying to figure out what problems the founders are solving. How do you identify the problems that are necessary? How do you sort of evaluate those things? So I think it's one of those things you don't know what you're doing initially, but as you look backwards, you can sort of put the dots together. And I think it's a unique journey that everybody goes on their own. So I don't think my path is the right one for everybody, but it sort of has led me this way. Now, particularly about the investing part, I became an LP investor in funds. I was doing angel investing, and I said no to Inventus for about 5 years until I finally said yes. I never saw myself behind on this side of the table, and I think it was sort of built in trust, getting to understand what the difference is being a coach versus being a player, right? And I think I really enjoyed being a player, but I hadn't been a coach. And I think having been exposed as an investor, as an angel initially, allowed me to sort of appreciate this part as well. So about 13, so 14 years ago now, I sort of made the jump.
How exciting! And that shift certainly from being a scientist, being a leader in an operating role, to now an investor across so many companies is such a big shift. What's the philosophy of Inventus, and how do you look at the world?
Yeah. So our philosophy and Kritika sort of started out with my other partner, Kanwal, who also happens to be my uncle as well. And that's probably one of the reasons I said no for so many years before I said yes. But we actually look at entrepreneurship as the purest form of wealth creation, as well as the engine for growth for any economy or anything else, right? And so I think it's the most noble profession you can do. And I think we, as investors, or we look at ourselves as more as therapists, right? It's really hard starting a company, running it, scaling it, right? It's not something you can go back and depend on your parents or your spouse or somebody else to sort of help you understand. So I think having been in their shoes, having done this before, we become that confidant that helps them sort of get from point A to point B. So the way we describe ourselves is, we take really good technical founders and we help them morph into good CEOs, right? Nobody's born a CEO, just like you don't go to college to be a product manager, right? I mean, you may become an engineer or a doctor, somebody else, but there are some skills that are best done as an apprentice, right? And I think we really take pride and we actually enjoy this part. And we've mentored tens of thousands of entrepreneurs over the years. And it's not like we invest in all of them, but we will spend our time actually helping guide them the right way, right? Whether or not we will invest in them. So I think for us, good karma pays back. Doing good back, comes back around. We have a very robust deal flow for that reason. I also teach at Berkeley and Columbia in the MBA program in growth hacking and finance. My partner BV Jagdish does this at IIT Bombay. Kanwal started Thai and a bunch of other things, and so we've sort of given back to the community for a long time, and I think that allows the ecosystem to sort of revert back to us as well. So the way we do evaluate, just to go a little bit more deeper, double clicking into it, we want technology to be a changer, right? So we look at least a 5x, if not 10x improvement over the incumbent way of doing stuff, right? So that's the bare minimum in terms of sort of okay, well, if this was to do it, there's technical legs underneath it, right? We also want the way we do from a fiduciary to our LPs is whether this one deal can return the entire fund back, right? So it's the return of fund potential, our ROFP is. So we evaluate. We have to convince our other partners. Our philosophy within the firm is like if any one of us decides to be champion, we will get it done. So we don't do the lowest common denominator. We used to. We had a philosophy before where all five of us had to agree on things. And I think in that case, you ended up not doing some of the more exciting deals because it's easy to say no versus saying yes, right? And so if we have the passion, so I think that our philosophy is like we all have enough experience that we can actually sort of put our metal behind something and get it done. And so as a partnership, I think we've gone far stronger together as well.
That's really exciting, and certainly what you illustrated is investment firms, they evolve from the first fund, they evolve as the team gets bigger and as the landscape changes. One way in which the landscape is changing, and I know you have perspective on this, is there's more deal flow, there's more firms, there's more kinds of startups, there's more sectors and areas to invest in. How do you ingest and think about like that ever widening pipeline of things that you get access to?
Yeah. So we look at everything in a funnel, right? And then it's the top of the funnel, the deal flow is getting bigger and larger, right? And then once the company becomes a portfolio company, it's we call that phase the grinding phase. Right? There's a lot of work for the next 3, 5, 10 years where you're helping them scale, mentoring them, and then eventually the last part is the mining part, where the companies either has an IPO or an M&A. So each phase requires a different level of expertise from us to actually mentor and get the founder across the board, right? So in the initial part, the finding part, right, where the number of volume, as you mentioned, has gone up so much, we've started actually using AI to be able to help us analyze information, get data from different sources. So we're not spending so much time asking for questions that we could get sources for, right? We also know that the deck has only so much information, but the founders, this is just human nature. You share your best things forward, and you try to hide the things you don't want people to know, right? So as part of the diligence process is to sort of get the 360, feedback on the team, on the product, everything else. And so a lot of time gets into just digging for information, right? So can those things be done by a machine, right? Larger venture funds use analysts to throw things at the people at the problem. So before the GPs will get involved, a lot of data collecting, gathering, all that stuff has been done, right? Micro VC funds like us, can't do that. We don't want to end up having an army of 150, $200,000 employees. It's not scalable and it's not the best use of time. So I think AI, the technology the LLMs have really sort of changed the game to be able to do some of these things more effectively, right? If you have the right source of data, can you be able to pull and get a more subjective view of the founder? At the end, it's still our human experience and knowledge to apply on top to say whether we'll take the second meeting or the third meeting and eventually invest in the company. But to accentuate our qualitative analysis, we need a little bit more quantitative pieces that we're leveraging more AI for, and and we will outsource it too if other sources are coming out that are better than us, because we're not a software company purely from that perspective, right? The part that I really do like to spend time on, or the team does, is once they're a founding a portfolio company, how do you help them get access to their initial customers? How do you help them sort of scale and do all the things, because you want to differentiate and help them sort of stand out, right? And that's where the heavy lifting is sort of done. So how do we leverage all our resources, all our knowledge, all our network and connections, and do that at scale, right? I have 16 some thousand people that I'm connected to on LinkedIn, or at least that's what it says. Convolut has 70,000 BB. So cumulatively, our team has access to over 200,000 that are directly connected to. And then second and third degrees, as we pretty much can reach anybody we want. But it's really hard to know who we know and where they are at any given point. My database up here can't keep up with all those changes, and I think this is where AI dramatically helps our founders, get connected to the right people within our network as well, which is what a lot of our value is. And then connecting them to other VCs for future fundraising, right? Because if they can raise more capital for subsequent rounds, well, our money is also lost upfront, and so there's a very strong need for us to get them connected to more VC firms. And there's hundreds of VC firms now, right? The world was a lot simpler 20 years ago. There's probably a new VC firm being created every other week, right? We ran a program last year where our chief of staff actually connected, matchmade three of our startups raising capital at that time with 1,600 different VCs, and we matchmade based on what they were interested in on both sides. And one of our startups actually raised money from a venture fund we had never heard from. They led a $6 million round into, and so that was a success. So we're productizing fundraising based on, so we experiment, we figure things out, and sort of figure, okay, well, how do we do this at scale, right? Because doing one-off is not success. Can I repeat this again and again? So I think we bring the same philosophy we've done as founders to sort of saying, how do we do more with less with our limited resources we have?
That's really exciting, and certainly it's going to be a difference between how different firms want to apply AI as just another tool to enhance the work that they're already doing, because the volume and scale of what you described is just like so profoundly bigger every year, and as you said, new firms growing every week. I'm curious, as you approach that, what does that mean in terms of also deciding to make an investment?
Yeah, I mean, so when like I mentioned earlier, we take about 20% risk up front, and we have access to 5x more pro rata in general.
Mm-hmm.
So we have a full-time partner on board who actually is a world-leading data scientist and AI expert, right?
Mm-hmm.
So us to understand how our company is doing, helping them with the analysis of data so that they can do better themselves, but also we're looking at this information to figure out where we put more capital to work. So we're only putting 20 cents on the dollar up front. And over time we may be putting 10 to 20 to 30 times more capital to work in that company, right? So our decision making is not just at the initial gate when we do the first
Yeah.
investment, but each subsequent investment that we want to be far more informed. So the quantitative data coming in, so we can make more, so it's not just a gut reaction based on our pattern, but also the data that's coming in as well. So I think that's sort of a differentiation
Yeah.
on how we sort of lead stuff. And then the top of the funnel, I would sort of say, 60 to 70% is still based on our analysis of the founder, our qualitative piece, because there's not that much data at the seed stage, at the pre-seed stage, right? And so, and then the subsequent rounds, the weightage of quantitative versus qualitative starts shifting.
Yeah, that's very helpful because you have different types of data, and also I think taking a step back, you're looking at the data and what that tells you in terms of what the portfolio should be constructed to look like. And I gather that is very different than typical portfolio construction, where you kind of work backwards mathematically to get the outcomes you want, to say, oh, I'll invest in so many companies at this stage, and then a bunch of them will graduate to the next round, and I'll invest in a percentage of those, and maybe invest further downstream if it's a multi-stage fund. This certainly seems much more dynamic in terms of like what the results tell you should do.
Well, I mean, just to give you an example, right? So most seed funds, or almost all seed funds, they'll probably invest 75 to 80% of their money in the first round, right?
Mm-hmm.
So you own high, and then you have 25% for defense or protecting your pro rata, right? We do the opposite. We do about 20% upfront, right? And 80% is now saved for our winners down the road, right? So the ones that do succeed, we want to overweight them. So by essence, we've actually are respecting the power law, right? And so you should be putting more money for those 1 in 5 or 1 in 10 winners that are coming through in power law, right? And not have to sort of spread the same capital across all of the companies, because by mathematically all of them can't succeed, right? Because we're in a power law situation. So we've actually constructed our firm to actually do the investments to respect the math behind it.
Now that's a great illustration, and thanks for pointing out that yes, this is the power law at work. 90% of your returns will come from 10% of the investments.
Yeah.
How do you share this kind of approach to investing with your own investor base? Like how and what kind of investors are usually a good fit for a fund like yours?
Yeah. So personally, I actually like family offices and HNIs, people who are still in their prime. They're running companies, C-level execs. So they can invest, $500,000, $1 million, in that range. But they're not the institutions. I also like them for a different fact, that they are able to mentor and help and introduce our startups to other, to their network as well, right? So just like it takes a village to raise a kid, I think I see us as sort of the parents for the startups or the coaches, but having an LP base that is also excited and can actually add value adds quite a bit. So it's also a contrarian approach. I wouldn't, it'd be amazing to have, if you're raising a $100 million fund, I would rather have 400 LPs at $250,000 each than 10 LPs at $10 million each.
Yeah.
Right. It's because I think more is not more effort. It's that those problems can be solved with software, and we've already done that. Right. So managing a large number of people, but it's matchmaking those people. Now they're committed. They're also more likely to help the founders. So that's the philosophy that I have on the firm as well. Right. But again, if somebody comes in with a $10 million check, we're not going to say no. But where we focus our energy is the one I mentioned to you.
Right. And there seems to be this consistent theme in terms of, when you start to work with a startup with a founder, you're helping them in their journey to becoming a CEO and to get the first customers and so forth. And your LPs want to play a role and add value, as you described, beyond just capital. So there's that there's that thread, that DNA that you seem to have built inside and out.
Yes.
Yeah, that's super helpful. I think that's often a counterintuitive thing for LPs to understand. Usually they expect, oh, you get into the hot deal and then you go and help those companies. But what you're describing is you help a lot and then you develop a reputation to get into the best investments.
Yeah. I mean, I think founders do the diligence. I mean, that the good ones do, right? It's not just money you're getting from someone. It's also, money is just money. And money in the hands of a banker is just interest, right? But in the hands of a trained VC, can add leverage to you, right? So we, as become coaches alongside with the founders. The founders are in the driver's seat. They're making the decisions. We're there to help them. Hopefully avoid mistakes we've already made or we've seen them make before, right? And I think that's what we're not the only ones that do this, but it's you sort of become confidants along with them, right? My 6-year-old daughter had asked me once, it's like, what do you really do for work, right? Besides talking and emailing, right? I think it's you sort of become good therapists, right?
Yeah.
If you're having problems at home with your spouse or at your parents, well, that affects your work, right? Who do you talk to? You can't talk to the people that you're closest to at home or your family. So, so we want to become that person you trust, right? Once their money's in, I can't take it back. I mean, the money's in your bank, right? So now we're the same side of the boat, right? On the table. So how do we sort of help them get through all the ups and downs it takes to sort of get to the other side, right? And also then finding the LP base that also understands that, right? It's not just like, hey, I'm sitting in New York and I've invested in a bunch of VC firms and they don't have an idea what it takes to build a company, right? It's more of a glorify. They only read the successes when they happen, and they assume that everything was up to the right. But as you know, the journey has it looks more like an EKG report more than anything else. Right? So it takes effort and time and the sausage making that happens in between. So we want to, I mean, I wouldn't say all our LPs do this, but roughly half of them get involved, and we do our demo days. We actually connect our startups with with our LPs very effectively, and I think this allows our LPs to actually be part of the story rather than just looking at our quarterly reports, right? But everything we do is focused on one and only one KPI, is IRR improvement, right? So the reason we connect our LPs is because it actually leverages our resources that we have access to be able to help the founders get access to customers, to VCs, to exits, right? Mm-hmm. When we use AI, it's the same thing. Well, I can do more with less, which means I can find the better companies, I can get them access to more customers, I can find the exits. Well, that's all to improve the one KPI IRR, right? So everything we do is sort of, we have to answer the question: does that improve that one KPI that we're looking to do, right? So these things become advantage. So I think a lot of VCs would sort of say, okay, well, I don't want 500 or 400 LPs because that's too much effort. Well, if we had more LPs and they were in the right sort of segment, well, that actually really helps our founders, which actually helps the IRR. Now, if it's a question of me having less time to play golf or go skiing, well, that's a different problem. Can we solve it by software, right? And so rather than sort of dismissing things because that's the harder thing to do, I think we've gone the contrarian approach and sort of saying, well, if it makes sense for us to improve IRR, whether it's the exits or the middle part or the first part, we'll do it, and then we'll find a solution around it.
Yeah. Sometimes, as they say, the obstacle is the way.
Yeah, that's right.
Yeah. That's really powerful. When you think about what's happening outside of Silicon Valley and how the industry is changing, what you said, there's new funds popping up all the time. That's happening in other markets and so forth. How do you think about investing across borders? How do you think about the growth of different startup ecosystems?
Yeah. just like anything else, you have to have a differentiation. Otherwise, you get slaughtered, right? Easiest way to lose money is to start doing things you don't have proficiency in, right? Uh, so for us, our forte is software. I mean, deep software expertise, and then the Indian community, right? Whether the Indian community was already in the Bay Area or they are in India, right? And so that's where our stronghold has been for the last 20 some years. So we'll only invest on those two areas. So some are cross-border because the founders may be in Bangalore or Bombay, but eventually their markets will be in New York or London or here, right? So we'll invest in those companies, but we require them to be Delaware corporation, right? Or a Singapore corporation, or you came to college to to the U.S. and then you stayed on and you started a company here. So we don't see a difference. It's just when you decided to move.
Yeah.
And because we understand these two ecosystems really well, we all of us have worked in those two ecosystems. We understand the space, and so I think we have a strength in this community, and so we'll invest heavily. We do about 8 investments a year. I don't have to go to China or to Russia or to Europe or somewhere else because we're not limited by deal flow, right? We get about 2 to 3 thousand deals a year, and we do 8 investments. I don't need to expand and go to areas where I don't have an expertise or background. I can't test whether that university is good or that founder is good. So we need our ecosystem to actually, to help us through that process as well. So I don't think we will expand either on stage or on geography from what we have found success already.
Yeah, and certainly you found an important channel and an interesting bridge between U.S., India, and that community and diaspora that's here. We're running up on the end of our time. For folks that want to learn more about Inventus and more about the work that you're doing, how can they find out more or get in touch?
Yeah, absolutely. So a few ways. One, I think our website, inventuscap.com, is a good place, but it's static. If you want more of a dynamic sort of conversation, I do a newsletter called Inside VC, also found through our LinkedIn profile. And then Kanwal is extremely prolific on social media, especially LinkedIn. So I think if you want both the entrepreneurial sort of finance view as well as the political view, because we still operate within a larger ecosystem. I think we're very open with our thought process. We also detail out the entrepreneurial traits of a founder. We look at a lot of things besides the KPIs and finances. It's the person, the founder, that makes a big difference. And so we look at specific entrepreneurial traits, and we actually disclose all that information on our website as well.
Wonderful. Thank you so much. This has been such a pleasure, and I've really enjoyed the opportunity to have you share the work you're doing, your unique perspective on venture and how you do it, which is certainly very differentiated as you described. So hope that our audience will follow up, learn more, and keep track of what you're doing.
Well, and thank you so much for having me on board today. I appreciate it.
Pleasure. Cheers.
All right.